April is opening in exactly the kind of market that makes weak people emotional and strong people interested. That is how I see it. Every day the tape is getting pushed around by the same ugly tug-of-war. One scenario says the pressure eases, the rhetoric cools, and the market gets to breathe. The other says the conflict deepens, uncertainty expands, and everything tied to risk gets marked down again. Right now the market is trying to price both stories at once, which is why so many people feel like their portfolios are being jerked around by forces they cannot control. They are right. In the short run, that is exactly what is happening. A headline comes out, the market rips higher. Another headline comes out, the market gives it all back. A ceasefire is announced, people cheer. A violation is rumored, people panic. A tariff gets softened, stocks jump. A new threat appears, stocks fall. That kind of market makes ordinary investors miserable because it flatters the illusion that if only they could predict the next political twist, the next geopolitical headline, or the next short-term policy pivot, then they could finally invest with confidence. I have never believed that. I have never built capital around the fantasy of forecasting every short-term variable the world throws at us. If you need a crystal ball to hold your portfolio together, then your process is already broken. That is the mother line of this whole story. Short-term chaos does not cancel long-term value, and the people who make the most money in markets are usually not the people who guess the next headline correctly. They are the people who knew how to zoom out while everyone else was trapped inside the noise. That is exactly what I want you to do here. Open the chart. That is step one. Open the chart and look at the long arc, not the tiny little patch of fear everyone is currently overreacting to. If you are buying actual quality and you intend to hold for years, the short-term chart is often the most misleading part of the entire picture. Most people get hypnotized by the ugly little section where dips keep dipping and where every buy feels early and every early buy feels foolish. Fine, I understand the emotion. Nobody likes buying what keeps going down right after he buys it. It bruises the ego. It makes people feel stupid. It makes them question whether they were looking at value or simply catching a falling knife. But that is exactly where zooming out matters. The same little section that looks like a disaster close up often becomes almost invisible when you step back far enough to see the whole machine. Even the person who bought before the peak of a major downturn often still bought at a much better level than huge stretches of the future chart. And the person who bought slowly over time through those ugly sections often ends up with an average price far lower than the panic made him think. That is why I do not let the market train me to think in tiny windows. If the asset is real, if the moat is real, if the earnings power is real, if the long-term story is still intact, then the current markdown is not automatically danger. Sometimes it is simply the toll you pay for getting in before comfort returns. That is the lens I want you to keep on while we move through these four stocks. I am not interested in just telling you what is down. Lots of terrible businesses are down. I am interested in the names where the drawdown has become detached from the long-term value creation still happening underneath. That is where the real work begins. Let us start with Robinhood. Robinhood has been cut in half from its highs last October. That gets people's attention. A stock gets cut in half and suddenly everyone starts asking the wrong question. They ask what must have broken. Sometimes the answer is the business broke. Sometimes the answer is the stock got repriced while the business kept getting stronger. Those are not the same thing. And if you cannot tell the difference, then every correction looks like a prophecy instead of a setup. In this case, the source makes a very specific point. The stock got cut in half, but the business did not. The price to sales multiple collapsed from around 31 to around 14. That is a dramatic change in how the market is valuing the company. Yet underneath that compression, Robinhood kept building Fay turn 38 file 0 Fay that matters to me. Because what has Robinhood really become? It is no longer someone trick meme era brokerage for bored retail gamblers clicking options from their phones. That framing is stale. The company has built a much broader financial apparatus, brokerage, options, crypto, futures, margin lending, credit card retirement accounts, prediction markets, venture access, and a growing premium layer inside its gold tier. Those are not decorative side projects. Those are business lines. multiple business lines. Each one deepens the relationship with the customer, and each one creates a stronger economic engine than the market used to associate with the brand. Fe file a site, fe turn 38 file 0 fe. That is important because I care less about count by itself than I do about economic depth per account. The source says average revenue per user is rising and that Robinhood is not only adding new accounts, it is deepening the relationship with the accounts it already has. That tells me this is not just superficial user growth. It tells me the company is becoming more valuable per customer. Recurring Gold subscriptions are growing, product breadth is widening, engagement is deepening. Those are the signs of a platform maturing into something much more durable than the market. Original stereotype, fe file site, fe turn 38 file 0 fe. Now let us add the part that really caught my attention. Robinhood was named alongside BNI Mellon as one of the platforms involved in administering the new federal Trump accounts program. According to the source, the government is setting up savings accounts for American children with a federal contribution at birth, and Robinhood is going to be one of the platforms handling these accounts. Think through the long-term implication of that. A whole generation of American kids growing up with Robinhood as one of the default financial interfaces in their lives. A brand seed planted at the earliest possible stage. That is not a quarter-to-quarter catalyst. That is distribution architecture. That is future pipeline. That is how platforms stop being products and start becoming habits. Fe file a site, fe turn 38 file 0 fe. So when I look at Robinhood here, I do not see a broken story. I see a maturing fintech platform with more lines of revenue, more recurring behavior, stronger monetization, inside buyback support from management, and a government-adjacent growth tailwind the market may not be fully valuing correctly yet. And if Wall Street's median target still implies more than 70% upside from here, as the source states, then at the very least you are looking at a situation where the fear in the chart and the operating reality underneath are not telling the same story. Fe file a site, fe turn 38, file 0 fe, that kind of mismatch is worth attention. Now let us go to Nike. This one is different because unlike Robinhood, where the source is basically arguing the business kept marching while sentiment collapsed, Nike actually did damage itself. That matters. I do not like pretending every stock decline is a misunderstanding. Sometimes management earns the drawdown. Nike peaked back in November 2021. Today, according to the source, it is trading near price levels last seen around 2014. Think about that. Roughly a decade or more of stock market progress erased in the quote, a brand this globally recognized, this culturally embedded, this operationally sophisticated, taken back to what the source calls the Stone Ages in price. That does not happen without real mistakes. Fe file site, fe turn 38 file 0 fe, and the source does a good job laying out the three big ones under the prior CEO. First, Nike pulled away from wholesale partners like Dick's and Foot Locker and tried to force more of the business through its own direct digital channels. On paper, that sounds elegant, higher margin, more control, more direct relationship. The problem is business is not built on paper. It is built in the real world. In the real world, that move weakened physical market presence exactly where regular consumers actually shop. It sacrificed reach for theory, fe file site, fe turn 38 file 0 fe second. Nike neglected performance innovation and leaned too heavily on its legacy franchises. Dunks, Air Force Ones, Jordans, great brands, powerful nostalgia, but the source is right. Saturation destroys mystique. The more you flood the market with what used to feel special, the less special it becomes. That strategy worked for a while as monetization, then began to work against the brand as dilution. Fe file a site, fe turn 38 file 0 fe third. While Nike was overfeeding old classics and underinvesting in renewed performance leadership, competitors like Hoka and New Balance stepped into the vacuum and built younger, more loyal followings. Nature hates empty space, and markets do too. If the leader leaves a gap, somebody fills it. Fe file site, fe turn 38 file 0 fe, those are real failures. You do not have to romanticize them. Now, the question becomes whether those failures are terminal or whether the market has over-punished a still great brand for them. This is where I think the source becomes interesting. A new CEO is in place, Elliott Hill, a 32-year Nike veteran who came out of retirement specifically for this job. I like that detail. I like it because turnarounds are not only about ideas, they are about who is trusted to execute the repair. A company this large, this global, and this culturally complex does not need a tourist at the top. It needs someone who understands the bones of the machine. The Source argument is that Hill has already started trying to reverse all three major strategic errors at once. Fay Felicite, Fay turn 38, file 0 Fay. Now, will that take time? Of course it will. That is exactly why the stock is discounted so hard. Turnarounds always offend the market because they cannot be completed in one quarter. The market wants instant proof. Real businesses change slower than charts. But when a great brand with worldwide recognition, deep consumer memory, and still massive distribution capacity is priced as if 12 years of progress never happened, I pay attention. Because in situations like this, the brand itself may be worth materially more than the quote currently implies. That is what the source is telling you. And I think that is a fair way to frame it. Nike is not being bought here because the turnaround is already done. Nike is being bought because the discount has become too severe relative to what the brand still is and what even a partial repair can mean. That is not the same thing as certainty. It is asymmetry. Now, let us move to Salesforce. This one is especially interesting because software as a sector has been punished so hard by AI fear that a lot of people have forgotten how to think properly about enterprise lock. In Salesforce peaked around December 2024, just above $365. And now, according to the source, it is sitting around $185, roughly a 50% drawdown. The price to earnings multiple is around 22.58, about half of what it was a year ago and a fraction of what the market was willing to pay at many prior moments. That by itself gets my attention. Not because a cheaper multiple alone makes a stock attractive, but because I always want to know whether the price compression is reflecting real erosion or emotional category panic. Fay Felicite, Fay turn 38, file 0 Fay, and right now the panic category is clear. People are terrified that AI will eat software. Fine. That fear is broad enough that it is hitting things without enough discrimination. Some software businesses may indeed be damaged or commoditized by AI. But the source makes a very clear point here. Salesforce is not some fragile piece of surface software waiting to be replaced by a chatbot. It is deeply embedded infrastructure inside enormous enterprise systems. Once a large company has built its sales operations, customer workflows, support structures, data routines, and marketing automation around Salesforce, ripping it out is not an afternoon project. It is a multi-year, multi-million-dollar nightmare. That is what real switching costs look like. Fay Felicite, Fay turn 38, file 0 Fay, and I love switching costs because switching costs are one of the most reliable forms of moat in the whole business world when the cost of leaving you becomes absurd. Your customer relationship is no longer a light preference. It becomes structural. That is where pricing power and long-duration cash flows begin. Now the source then moves to what I think is the most exciting part of the story, Agentforce. And the reason it matters is simple. This is the bridge from enterprise software into enterprise AI, not as abstract hype, but as real workflow replacement inside live systems. The source describes it cleanly. Instead of a human manually updating records, writing follow-ups, routing tickets, or generating reports, an AI agent can do it automatically inside Salesforce. That matters, because this is not some speculative moonshot outside the company's core. It sits directly inside the company's installed base and existing data environment. That is exactly where AI monetization becomes dangerous for competitors and powerful for incumbents. Fay Felicite, Fay turn 38, file 0 Fay. And the adoption data is not imaginary, roughly 29,000 Agentforce deals in fiscal 2026. Paid transactions up about 50% quarter over quarter. Deployment in the U.S. Department of Labor. Deployment in the Veterans Health Administration. Usage by AstraZeneca globally. Those are not concept demos. Those are real-world implementations. That is what the source is telling you. And I think it matters immensely, Fay file site Fay turn 38 file 0 Fay, because once the market stops pricing Salesforce as legacy software with AI risk and starts pricing it as enterprise lock in plus AI automation inside the lock, in the whole framing changes. That is why I agree with the source's core instinct here. At current prices, Salesforce looks like the market is over, discounting the risk and underpricing the value of the moat plus the AI extension. That is exactly the kind of mismatch I want. Now let us go to the final name, Applied Digital. This one is different from the others because while it is still down sharply from prior highs, the source's tone is even more forceful after the recent earnings release. According to the source, the stock peaked around $42 in late 2025, and even after the latest numbers is still down around 40% from that area. Fine, that is a serious markdown. But then the source immediately points you to why that markdown may now be misaligned with reality. The street expected roughly $76 million in revenue. Applied Digital printed $126.6 million. That is not a slight beat. That is a massive beat, around 66% above estimates. Year-over-year revenue growth came in around 139%. The company also produced positive adjusted EBITDA and adjusted net income. Those are not fantasy infrastructure numbers. Those are operating numbers. Fay file site Fay turn 38 file 0 Fay that matters, because this is where a lot of investors still have the wrong mental model. They see infrastructure around AI and they think speculative shovel seller. That can be true for some names, but the source is very clear that Applied Digital is not just building generic cloud boxes. It is designing, building, and operating high power density data centers specifically for AI and high performance computing use cases. That is a much narrower and more valuable niche than people often assume. Training clusters, inference systems, 24 divided by 7 GPU operations. Those are not ordinary data center demands. They require specialized physical infrastructure. Fay file site Fay turn 38 file 0 Fay. Now add the CoreWeave relationship. That is the anchor. CoreWeave is one of the most important AI cloud players in the world, NVIDIA-backed, and operating in one of the fastest growing parts of the entire technology stack. The source says CoreWeave chose Applied Digital to build and operate significant portions of its compute infrastructure, with the North Dakota campus alone tied to multi-year contract value running into the billions. Then on top of that, the company broke ground on Delta Forge 1, a 430 megawatt T-campus in Louisiana. In other words, this is not a company with one lucky contract and a nice slide deck. This is a company actively scaling a pipeline in the exact direction the market keeps saying it wants exposure to. Fay file site Fay turn 38 file 0 Fay, that is the kind of contradiction I like. The market says it wants AI infrastructure. The market says it wants hard revenue. The market says it wants operating leverage. Then a company prints a huge revenue beat, positive adjusted profitability, contract-backed build-out, and still trades way below prior highs. That is where real opportunity tends to hide. The source also highlights something I think is crucial and often underappreciated by retail investors. The company is financing more intelligently than the market tends to assume, rather than perpetually issuing stock into the market to fund construction. The company is raising capital against the data centers themselves as physical infrastructure assets, more like toll roads or airports with contracted future rent streams. That does not erase risk, but it changes the quality of the financing model. It moves the story away from endless dilution and more toward infrastructure-backed scaling. Fay file site Fay turn 38 file 0 Fay that matters a great deal. Because if the world truly needs more AI compute, and all signs suggest it does, then the companies building and operating the right type of infrastructure are sitting in an unusually powerful position. And if one of those companies is down 40% while simultaneously blowing out earnings and expanding the pipeline, then I have to take it seriously. Now I want to step back and put the entire list in one frame. Robinhood is the maturing fintech platform whose stock got cut in half while the business deepened, monetized, and gained a government-backed pipeline to future users. Nike is the globally dominant brand punished for real strategic mistakes, but now potentially offering a deep discount on one of the strongest consumer franchises on earth. Salesforce is the enterprise software incumbent with brutal switching costs that the market is underestimating precisely when its AI product extension is beginning to prove itself in live deployment. Applied Digital is the AI infrastructure operator still well below old highs, even after delivering the kind of revenue and profitability surprise that should force people to rethink the story. That is a good list, not because every one of them is guaranteed. Nothing is guaranteed. Because each one gives you the same kind of setup I am always looking for. A stock down hard, a business case still alive or strengthening, a moat or structural edge that still matters, and a market environment noisy enough to scare away shallow money. That is fertile ground. Now, I want to leave you with what I think is the most important part. Do not outsource your conviction. Do not borrow your courage from me. Do not borrow it from the source. Do not borrow it from anyone on the internet. Borrowed conviction disappears the moment. The stock drops another 12%. That is how most people lose. They buy because someone else made a good case. Then the stock falls. Then they realize they never built their own understanding. Then they panic. Then they sell. Then they call themselves long-term investors the next time something excites them. Number, if you are going to buy a stock in a market like this, you need to be able to answer one question after the excitement is gone. Why do I own this? And your answer must be better than because somebody I trust liked it. Your answer must live in the business, the balance sheet, the moat, the adoption, the valuation, and the long-term path. That is what makes conviction durable. That is what lets you zoom out while others get trapped in the little ugly patch of the chart. That is what gives you a chance to make money when everyone else is only making noise. So yes, April 2026 is volatile. Good. That does not bother me. Markets like this create confusion. Confusion creates markdowns. Markdowns create opportunities. And opportunities in real businesses are where wealth gets built. That is where I want to be looking. And that is where I think you should be looking too, if your horizon is long enough and your thinking is strong enough to match it.